Good morning, everyone. This is Marshall Gidler bringing you the morning comment for March 12th. The euro continued its collapse yesterday as more and more market participants jumped on the trend. People were waiting to hear some comments from ECB officials about how enough is enough, the pace of decline is too much, or something like that. But ECB President Draghi and ECB Governing Council member Nowotny made no such comments, while the Italian finance minister said the dollar's appreciation against the euro was in line with the economic fundamentals. Meanwhile, St. Louis Fed President Bullard had said the Fed was already late in hiking rates, so monetary policy divergence lives. Some time ago, the widely watched DXY index broke out of its 30-year downtrend. Recently, the same thing happened to the Fed's major currency trade-weighted index. This index includes Australia, Canada, Japan, Sweden, Switzerland, the UK, and the Eurozone countries, and is much more rationally weighted than the DXY. The breakout here confirms to me that we're still at the start of a broad dollar rally. The Reserve Bank of New Zealand kept interest rates unchanged overnight and signals an extended period of steady interest rates. The Kiwi strengthened after the report on the idea that rates would be on hold for some time and then eventually start to rise. Nonetheless, I think they could be signaling intervention in the FX market to weaken the currency because their comment on the exchange rate was even stronger than it was in January. I see the New Zealand dollar depreciating against the US dollar, but appreciating against the Australian dollar, which is more heavily leveraged to Chinese investment. Furthermore, RBA Assistant Governor Christopher Kent yesterday repeated the RBA's mantra that the Australian dollar is still too high. The comment was particularly significant because Aussie US dollar yesterday hit 0.7561, meaning it had reached the 0.75 level that RBA Governor Stevens identified back in December as, quote, an appropriate valuation, unquote, for the currency. I think Kent's comments signal a change in view at the RBA because the state of the economy and the outlook for the Australian economy have worsened since December. This is why I remain particularly bearish against the Australian dollar. As for today's highlights, German final CPI for February came in at minus 0.1% year-on-year, unchanged from the preliminary estimate as expected. Eurozone industrial production for January is also coming out later today. In Sweden, the official unemployment rate for February is expected to decline. Following the encouraging CPI data, a decline in the unemployment rate could suggest an improving economy and support the Swedish krona temporarily. In the UK, the trade deficit for January is expected to narrow a bit. The Bank of England also publishes its quarterly bulletin. In the U.S., core retail sales for February are expected to accelerate, which could add to the greenback's strength. Initial jobless claims for the week ending March 7th is also coming out. As for the speakers, ECB Executive Board member Kur and ECB Governing Council member Weidmann speak. Weidmann, of course, is the uber hawk on the ECB Council, so his comments should be an interesting counterpoint to Draghi's comments yesterday. Also, Bank of England Governor Mark Carney speaks for the second time this week. For more information, including technical analysis, please read the full comment on IronFX.com. You can also follow us on Twitter, like us on Facebook, subscribe to our YouTube channel, or circle us on Google+ to get more trading ideas. This is Marshall Gidler, head of Global FX Strategy at IronFX Global, wishing you solid trading.